Hey, Jeppe.
Hey, Hades, how are you?
Good, thank you. How are you doing?
I'm good, thank you.
Are you nervous or you're okay?
I think I'm all right.
That's great.
I'm always a little bit nervous, but I think I should be sufficiently prepared and everything.
Okay, hello everyone. I'm Hadass from the Popular Investor team. Thank you all for joining, and thank you, Jeppe, for giving us this call. We have a lot of participants today. So Jeppe, you can start. Please just everyone make sure to keep yourself muted unless in the end, Jeppe can give time for questions and for people to jump in if you allow that. But just make sure because it really can disturb. Thank you.
Thank you, Hades. So I'm Jeppe Kirk Bonde, and yeah, welcome everybody, and thank you. So the agenda for now is that I'll talk a bit about my background, then my investment strategy, my portfolio, and finally there'll be the opportunity to ask questions and get some answers. So the reason many of you are copying me is likely that since 2013, I've had an average annual return of 34%, which is better than anyone you could really fairly compare with, and with a better return to volatility ratio than most others. If you wanted a better performance than that, you would effectively have had to, invest like Jeff Bezos or another top tech founder, but there would also have been a lot higher volatility along the way. My background is in management consulting, so I worked advising large companies, including tech companies and banks, in strategy. And one of the products I worked the most with was valuation. So really evaluating how much is a company truly worth. And then as I was doing that, I started making some money and I wanted to invest my money. And then I compared all the different platforms on, how good is the app, what instruments are available, what are the fees like, and so forth. And I picked eToro as the best one. And I've been very happy with that one ever since. And then as I continued doing really well with my investments, more and more people started copying me. And so today, more than 25,000 people copy me and almost 500,000 follow. And I've now for a total of 75 million US dollars, which is unfortunately the maximum at eToro. So new copyers can no longer invest, but existing investors can, of course, continue. I don't do everything on my own. I have a good network of experts that I trust, especially on issues that are very technical in nature. Essentially, if I invest in something, I either have to be an expert myself or know someone who is. And so there's also a slight bias in my investments towards industries that I've myself worked in as a management consultant. I also have 4 assistants that help me with financial analysis, and one who will edit this video after if needed, and so forth. I get strong support from Hades and the rest of the eToro team whenever I have a question, of any kind of detailed nature. They'll provide me with some good answers. And I subscribe to the best data tools and IT tools. So yeah, sort of any way I can sort of try to get myself a small edge, or at least not fall behind on any aspect. And finally, I'll highlight the 3 people from my network I like the most, my 3 brothers. One, he's worked for many years with AI in a large tech company. One is working in the Ministry of Finance, and the final one is the CEO of a large marketing company. So if I have any questions within those areas, then these will be my go-to guys. My investment strategy is based on some principles that have been there all along and continue to be here. Firstly, I look at macroeconomics. So what kind of growth rates do I expect different market segments can have? I identify mega trends. So these are trends that can grow by more than 10% per year for at least 10 years. I focus a lot on fundamentals. So that means really getting a 360-degree view of companies. What is their management like? What are the products like? What is it like to work there? What's it like to be a customer there? Do I like their strategy? What sort of impact will different technological changes potentially have on them? What are their financial statements like, and so forth? All with an eye on valuing the company and assessing what is it really worth. And then I want to invest in companies that are worth a lot more than they cost. I focus a lot on the long term, and that's probably the most counterintuitive for people to understand. So I'll spend a little bit of time on that one. There's a good quote by Benjamin Graham, the author of the famous book, The Intelligent Investor, and sort of Warren Buffett's mentor. And he said that in the short term, the market is a voting machine, but in the long term, a weighing machine. So in the short term, it can be very important what other people think and what other people think. But in the long term, if you own a company that's become very, very big and profitable, then one way or the other, you will make a lot of money from that. And when I invest in a company, it's because I think that it's worth a lot at a low price. But what that really means is that I think that the weighted average investor is wrong. And when I think other people are wrong, I don't think the most likely case is that they'll stop being wrong tomorrow or next quarter or even next year. So when I buy something, I don't mind having to wait a long time for it to, reach the valuation that I've assigned to it. And if whether I'm proving right in 3 months or a year or a decade, it's all more or less equally good to me. And yeah, that's what I essentially mean with focusing on the long term. I'd rather forgo the short term to be rightly positioned when the big things happen. And I genuinely believe both when running a company and an investment portfolio, you're much better off trying to think as far ahead as you can than always being focused on next week or next quarter. I focus a lot on risk management. I'm well diversified across different geographies, industries, and business models. I currently have 56 different assets in the portfolio, and I generally don't put more than 5% into a single asset, except for special cases. And I'm well hedged against tail risks. So these are risks that are very unlikely to happen, but if they do happen, then they could have an outsized impact. And for those who like to have at least one asset that I think could do very well in that particular or that range of scenarios. And finally, I keep fees low. So that means I avoid having an excessively high trade frequency. I don't use any short selling or leverage, and generally avoid high fee instruments. And that's sort of just one more way you can squeeze a little bit more return out of one's portfolio. Where do I then see investment opportunities? I like companies that have high organic growth. So that means companies that are selling more products or increasing their prices, but it does not mean companies that are growing just by buying up other companies. Quite often you can read in the first page of the annual report that, wow, this year we grew revenue by 2%. And, then I think to myself, yeah, you grew the revenue by 2% by buying a company. Core business shrunk by 5%. So it's not really that impressive. I like companies that are resilient. So that means that, they have a future fit business model and are more likely to disrupt than be disrupted. They can do well in multiple scenarios, not just one, and have a good balance sheet. I like companies with high growth, especially if it's combined with a high proportion of their costs being more or less fixed, or at least sort of like not too flexible. Because that means that if they can increase sales a lot over a number of years, then the profitability picture can just look completely different. And so you can have a company that has losses in the short term that just ends up looking completely different, and that can sort of be the route for a great investment. I like to invest in companies when they've changed their strategy, but it's not enough to me that they say they're changing their strategy. I have to see some real actions behind. So some examples there are, when Ørsted, the Danish energy giant, they changed their strategy. They didn't just say they were changing their strategy. They sold off a big part of the business and then changed the company name. This told me that they were serious about this, and then that turned out to be a good time to invest in them. On the other end, I saw another very large company within the oil and gas space, and they announced a new strategy as well, and it was all over the media. But when I actually read the strategy, what it really said was they were promising to do the absolute bare minimum by 2050. So I was like, right, you want me to believe there is a new strategy, but there is not really a new strategy. So this is not, something that I'm willing to I would invest at a certain price or whatever, but it's not something that excites me in any way. Then in terms of products, a classic example, sort of, you don't always have to predict the future. Sometimes it's okay to just understand what's going on in the present. When the former CEO of Microsoft, Steve Ballmer, he held the first iPhone in his hand, he said that, oh, it doesn't have a keyboard, it's way too expensive, business customers won't like this. I'm very comfortable with our position. And he was, of course, proven wrong by the success of the iPhone. But that was an example of holding the blockbuster product in your hand and not being able to see that that was the blockbuster product. And, many people have recently made the same mistake with Tesla, just not seeing it for the great product it was. But if you're a smart shopper, if you can, take any category and you can just go out and find out what are the key features here, what determines if a product is great value here, what are the aspects that I should consider, and you're able to actually buy the right product, then, that ability to compare products is an important a piece of the puzzle. If you can fit that in, then you're off to a good start. But if you can't do that, then I think then the whole thing will be very difficult. I like companies that are mission driven, not just because I sometimes believe in the mission, but also it can be a great way to attract and keep great employees and make them work hard, even though you're not overpaying them. And there are other companies where great people try as hard as they can to escape from there. And if they want to attract a great employee, they have to either overpay them or overpromise them, or in other ways do things that are not good for shareholders in the long run. And whether a company is in one camp or the other might not show up in the financial statements 3 months later, but certainly within 2 years it will. Then my portfolio on eToro is more than 90% in stocks, and that makes good sense because historically stocks has been the best asset class. Property has also been quite fine. Bonds used to be okay, but now you have a lot of bonds. When you're buying something called a high yield bond and you look at the details, it's not really that high yield. And you have a lot of corporate bonds as well as government bonds where based on how the market is trading inflation, you're actually looking at a negative real return. So that's sort of one category where a lot of common wisdom has sort of doesn't really hold anymore. Commodities have historically not been very good. If you owned a gold bar during the Roman Empire and you kept that gold bar, then today you still have that one gold bar, and it doesn't buy much more labor time than it did back then. And so it can protect against certain scenarios, and it's done okay in the last decades. But fundamentally, in the long term, a gold bar does not spawn more little gold bars, whereas a company can spawn dividends and growth. And finally, currencies, thanks to inflation, have been quite terrible in the past and continue to not be very good. And whenever I have a lot of excess cash, I try as fast as possible to get it transitioned to the left in this chart and ideally into some stocks. Then when I look at the global economy, I like to sort of split it into the social and political and the technology and process based. Within the social and political, the absolutely most important thing is trust. And this is, I think, the most overlooked thing in economics. Essentially, our money, stocks, bonds, the deeds to a property, these are all just pieces of paper, ink on paper, numbers on a screen, a belief system we share, and fundamentally, it just trust that someone will do something based on some parameters. And if we believe in that, it can help us transact with one another and create great value. And if we stop, then that value can disappear very quickly. There are some movements and taste changes where something can go from the margins of society, but if it's growing at a double-digit rate, then within a few years it can suddenly be all over society. And if you invest at the right time based on that, then it can be a great opportunity. Sometimes there are parts of a market that are not accessible to us, but if they are liberalized, they are. But on the other hand, what is liberalized can also be taken away again. Companies that are or countries that are characterized by institutional effectiveness are good for us as investors and good for their countries in general. And finally, diplomacy, whether that's EU, UK, or US China relations or China India relations, or what it is something that's historically always been very important and continues to be very important. In the technology and process space, all the way from the deepest pits of the R&D labs to the end stages of the retail chain, there are great opportunities for investment. Some companies are characterized by best practices, but if those best practices are some that competitors can easily imitate, copy, then over time you'll see the difference between the leader in the industry and the people that are catching up close. On the other hand, if you have a company that's characterized by continuous improvement where it's constantly accelerating away from their competitors, then you'll see that gap grow over time, and that can be a great opportunity to invest. Mother Nature sometimes throws us some curveballs, and I used to have Ebola in my presentation. Now, of course, changed it to COVID, and there are demographic changes that if you have some countries have a certain demographic look right now, and it's going to look very, very different years down the line, whether that's countries where a large segment are going into the retirement age or young people coming into the best working years of their life. And the companies that have the right products for the right demographic profile in the right places, they have a large advantage. And finally, sometimes there are some mega projects that can really drive growth. It's not always that the mega project itself is a great investment, but when Inmarsat, for instance, sends up a big fleet of satellites, may or may not be great for Inmarsat, but it's certainly good for the satellite terminal company that makes the terminals that work with these satellites. Then when you take all of those sort of factors in, you can see where the economy is now. So if you take the average of a couple of data providers that I use, we can see for the GDP growth rate, it's expected to not, in 2022, not too much will happen in the US EU and Brazil, but China and India will continue to sort of race ahead. In terms of unemployment, these are the most recent government provided numbers, and they certainly don't look too great in some areas, including India, Brazil, and the EU. And if you look in the EU, it's and Brazil, it's not just because of COVID. When we say return to normal, actually unemployment was very high here before COVID as well. So there are some, especially in Europe, in Southern Europe, there's some problems there that will return to and have to be fixed and aren't just sort of COVID's fault. In terms of interest rate, they're quite low across the board, maybe except China. And what that effectively means is that's one piece of firepower less central banks have in case there is a new unforeseen issue. So a new unforeseen issue could be, a new variant of COVID or an unknown, or any of the many things we've seen happen in global finance over, time immemorial. But for anything like that, it's always good to have an idea of how much firepower do the governments and central banks really have to counteract such an issue, because then you have to worry about too much about which issue it's going to be if you know that there is a sort of firepower enough to solve something. In terms of inflation, it's in the last 4 years, this is the average over the last 4 years, we can see that the US is hitting above target. And a target is only a target if you're actually aiming to stay at that target. If not, then you can question the sort of terminology. And if you look at how the market is trading different inflation protected products, you can also see that the sort of numbers we've been seeing on average over the last 4 years is also what the market is expecting for the next 3, 5, and 10 years. So you can sort of lock in inflation at this level of loss, and that sort of means that while inflation can be negative, and if you have very high inflation and your stocks go up in price, you might think, "Yoo-hoo, that's great," except when you sell the shares and you pay taxes on them, you now pay tax on that gain, and so actually. And if prices went up by the same amount, all that happened to you was you paid an extra tax, which is not so nice. But essentially, the sort of like the big worry is maybe there's a lot of excessive fear in that realm spawned by a lot of media, I would say. In terms of megatrends, I've identified some that I think are extra interesting. So if a company is driving or riding one or more of these megatrends, then it's more likely to be found in my portfolio. So within the digital space, I think that there is a global distribution engine being built where the more people buy things online, have them delivered at home, the more often delivery companies can come to homes. The more often they come, the cheaper it is to get delivery, the cheaper it is, the more people will want to have delivery. And that sort of virtuous circle, the companies at the center of that stand to profit immensely. I believe the future of security is very different from the past, whereas the Second World War was won with logistics and diplomacy and tanks and aircrafts. We now are in an age where it's really a battle of the hearts and minds. If you want to defend values like democracy, human rights, and capitalism, then it's really a question of who gets to slowly change people's opinions by an amount they don't even notice year by year over a few decades, and end up in a place where the values you are fighting for have won out. The companies that are providing the tools to make that happen and determine our security, they stand to do very well and are to be found in the portfolio. Within AI and robotics, the companies that have made the biggest breakthroughs in the past year are to be found in the portfolio. Within recreation, I have a large stake in gaming. I have one investment left in cannabis. And if we see more and more people enter the global middle class, then there is a increased demand for luxury products. People want the very best, and those are to be found in the portfolio. It's a lot of it's fundamentally, I don't want to invest in anything where I don't think my investment is not doing good for the world overall, when you sort of assess everything in a complex way. And a few years ago, I had a lot of oil and gas investments, which at that time sort of black energy and green energy cost more or less the same, and that didn't make any sense. So I sold off all the black energy and invested in green energy instead, which turned out to be a great move. But I don't think now that if oil and gas companies came significantly down in price, I would reinvest in them. I would have to be able to make the conclusion that my investment would overall be good for the world, which I'm not sure it would in that case, certainly not based on the current market outlook. I have some investments in recycling, some investments in health. If you look at sort of the biggest impact from COVID, can someone stop drawing on the screen? If you look at the sort of biggest lesson from COVID, I think a lot of people talked about work from home, but the real big change is the work from anywhere. And the sort of the way that I've been working for many years, I think more and more people are realizing is a smart way of working, and the people that don't work that way, they don't understand it. And that is unfortunately the majority of companies. People don't really understand how to work online in a good way. And because of that, people are trying to sort of move their bad on offline habits into the online. And but there's sort of there are some offerings that people realize are really, really great, and they have to be found in the portfolio. I analyze political science a lot, so Asia international relations is the most interesting field right now. And finally, if you want to sort of see into the future, a great way is to look at leader cities. So if you want to see where regulation might be heading, it can be good to look at a place like Singapore, which is ahead in that field. If you want to see where technology is going, you can look to Silicon Valley. For welfare and sustainability, you can look to my home city of Copenhagen and so forth. Then if you've identified an industry or a group of companies and you want to get a quick overview of the companies in that industry, then a great way is to look at the multiples. So this is an example of FANG, so Facebook, Apple, Amazon, Netflix, and Google. And if we look at the top left chart, that's the profit margin. We can see that they're all doing quite well, especially Facebook, but Amazon's sort of lagging a bit behind. If we look at the growth rate, again, they're all doing amazingly well. Apple's finally back into double-digit growth, but they are still lagging a little bit behind. Now, the two top charts, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they are fundamentally about price. So if we look at Facebook, for every dollar of profit they make, we are paying $23. And that's even sort of fine. But for Amazon, we are paying $61. So we only want to pay that much for Amazon if we believe that they could increase their profit margin or sustain their growth for longer or something like that. Otherwise, we wouldn't want to be paying more. When we then look at the price compared to the revenue, we can see we're paying $10 for Facebook, but only $4 for Amazon. Well, that also makes sense because we're getting a lot more profit out of every dollar of revenue for Facebook. And yeah, so overall, that's sort of a way to get a quick visual overview of an industry. Unfortunately, I don't get to look at beautiful charts like this all day, every day. What I tend to look at for most of the day are big data tables like this. So these can be data tables that are automatic. So they're updated from my various data providers. They can be manual. So, there is some data, but, I think it's wrong for certain reasons and adjustments need to be made. Or they're finally my uniquely crafted data tables. So these can be ones where, how good do I think the CEO is from a scale to 1 to 10? How beautiful is the website and so forth? So it's subjective, but it's numerical and can be used in my models. And all of this ties into my valuation and risk models that helps me evaluate which companies are the best investments. And those analyses then help me make decisions. Those can either be research decisions. So, there is a company that's sort of different to something I've looked at before, meaning I need to add in a new factor or look at things differently or just do more research to understand better. And, change things, change what kind of input I get, change my analysis. But in the end, the decisions have to turn into investment decisions. And then when you add up all my investment decisions, that essentially becomes my portfolio. And if we compare that with the economic activity in the US, you can see that in the US, it's not just one industry that has all the economic activity. There are many different industries that are each making up the economy, and there are great investments across many of them. In my portfolio, there's a slight skew towards tech, health, climate, gaming, and finance. But again, it's not just everything in a single industry as such. And if you look at the largest holdings in my portfolio right now, it's Google, Arubis, and Centene Corp. And you can always see everything that I have in my portfolio on eToro. It's publicly available. And that was my presentation now. And now there'll be the opportunity for questions. If you don't have a question now, but you remember it later, you can always comment on eToro. I'm on eToro every day, 365 days per year, and I usually answer all comments within 24 hours. Or you can add me or write to me on LinkedIn or watch some of my videos on YouTube. So now I'll go into the chat to read some of the questions. And yeah, thank you, everybody. How do you see the macro for the next year? Secondly, you mentioned about your experience in valuation. Do you use DCF with earnings or free cash flow? Can you talk about it? What do you do for new age companies which have neither in terms of valuation? Yeah, so when I do a valuation, it's, if you have a long past history, that's great. If you don't, it's sort of, you're still left with that you're not buying the past. Like The past is your guide to understand the future. So if you have if you have all the standard financial statements as you do with large public companies, then you can't just you can't just like draw a line to that and extrapolate from that. You always sort of have to build it from the other one and say, like, what is this company actually going to sell next year? What is what are actually going to be the prices? How much profitability can they actually have? And then it's this discounted cash flow with the free cash flow model. I think metrics like price earnings are for people that don't really understand financial statements. If you have sort of there's a lot of, I think certainly there has been a lot of evolution within valuation of startups in the last years, and I've certainly taken a lot of the knowledge that's been produced in that realm into the valuation of public companies. And that's sort of some thoughts on valuation. For those who have a high risk fund, do you still view Tilray and Nintendo as the outstanding picks? So I think in general, it can be very fine to pick individual stocks that have extremely high risk, but the most important thing with that risk is that risk does not correlate with the risks of other companies. You can even have a company that's extremely risky, but if its risk is that it does very well in a scenario where another company does badly or vice versa, then those two companies, super big risk, actually completely cancel each other out. A classic example of that is if you have a lot of oil, but you also have a lot of shipping companies, and the shipping companies need oil. Then if the oil price goes up, you made money on your oil, but you lost it on your shipping and vice versa. And so that's the kind of risk that is actually unimportant. And it can be very, very good to have a company where there is some risk scaring away other investors because they haven't really sort of understood how that risk ties in with the rest of the portfolio. Because at the end of the day, the real risk everybody should worry about is the total risk in their lives. So if you own a property, you own a stock portfolio, you have a job, and you have different expenses and different currencies and so forth, that's the totality of things that you need to risk manage. And it may not even just be for you, it could be for your children and dependents and other people as well. That's at the level. So if you can spread yourself across many different aspects in that regard, you reduce your total risk. And that's sort of and in doing so, you can reduce your total risk by adding an asset that's individually high risk. Where yes, if that was everything you had, you only had this one stock, you would be taking way too much risk. But by adding that into a portfolio of many other assets, into a life where you have multiple income streams, then the thoughts around the risk become completely different. Then someone asked, would be great to learn how the low trade frequency from the investment strategy aligns with adding more funds, given the copy open trades is not an option currently. You want to avoid having inactive, uninvested funds sitting. So that's very right. So in that sense, for most people, it can make good sense to invest up to 6 or 7% every month, but not much more than that, as then too much funds will be sitting idle for too long. In general, I have about 4.5 trades per week, but it's not 4.5 trades every week. That also includes months when nothing happens and months where suddenly everything happens. Essentially, if there's a small change in the value of a company relative to its price, but the difference isn't big enough to warrant paying the spread fee, then it's not worthwhile for me to make a change in the portfolio based on that change. And I don't want to sort of increase my trade frequency to make it better for certain investors at the expense of others. Someone asked, since we can't add money with copy open trades anymore and you don't trade very frequently, how long do you think it will take for newly added funds to be fully invested? And do you know when eToro will allow copying open trades? So I have not been told that there's any plans for it to be opened. It may happen, but there's nothing that I know of currently in the timeline for it to become possible again. And in terms of time space and the current trade frequency, it would on average take 9 months. But again, I cannot sort of what my trade frequency will be going forward entirely depends on the market conditions. Personally, I hope that there won't have to be any trades at all, that I magically picked out the 56 absolute best assets in the entire world, and they'll just continue to be the very best ones. But of course, as if history is any guide, that's not what's going to happen. Some of the assets that I own will be bid up or lose their value, and for whatever reason, something will become relatively more attractive, and I will make changes in the portfolio to continuously own the assets that on any given day I think are the assets that I want to every day construct the most valuable portfolio. And so I have my budget, which is the total assets, and that's my budget, and I have to allocate them to have the absolute most valuable portfolio I can have. And Today, the answer is quite similar to yesterday, and that's the case on most days. But there could be a scenario where I suddenly have to make significant changes, and there could be a scenario where that doesn't happen. Is the UK included in EU data on historical? No, it is not. Question as Charlotte and Peter is, we cannot copy open trades. How can we grow our investment without leaving funds idle by simply adding funds? Yeah, so that's not possible at the moment. You cannot copy open trades. When you add funds, then you can only copy new trades, which means they'll be idle until I make sufficient amounts of new trades. So when I make the first new trade, then part of it's invested in that. And then over time, as I make more new trades, the added funds become invested. Do you plan to rebalance your portfolio with this automatically invested funds we have standing by? So if I do a full reset, that would rebalance the portfolio. I did that in August 2020, but I cannot say that I will do that on a fixed schedule or on a fixed date or something. But if there is a scenario, if it happens that I'm going to make a lot of trades and I overall at that time evaluate it will be best for all copiers that I fully rebalance, then at that time I will do a full rebalance. But I will not sort of just do it and cause normal copiers that are not adding new funds to have to pay any extra spread. What are the health stocks you are invested in, and why did you choose them? There are subsectors of the health industry. Yeah, so they are specifically all in biotech. They are all leaders within their fields. They are all very high growth companies that are working in some very areas that each have some great kicker where they could rise quite significantly in value. And also where they already are profitable, so that it's sort of they can hold out to see that potential kicker come. And even if they don't have the kicker, then there's then sort of I'm happy enough to own them just based off of the expected profits of the next like 5 to 10 years. Jeppe, what are your thoughts about the theory of inevitable correction of the stock markets, considering that we are still in a new normal due to COVID, government support, low interest rates, etc., and that the market must readjust, crash some point in the near mid future as things normalize? I think that is the kind of thinking that has lost people the most money throughout history. Essentially, thanks to inflation, markets will quite often be at all-time highs. And people have this, half of the people that don't really know too much about investments will or a large part will go between the two thoughts. Either they will think the market's gone up, it must be too high. Or if the market's gone down, they think, oh, the market's gone down, now it's crashing. But whatever, their conclusion is the same. They won't invest. And in reality, if markets have historically increased by 7% per year in real return, and in any one given year, yes, it can easily be cut in half. It's done that many times throughout history. Or in any month, you can lose 20%. That's also happened many times before. But over a long period of time, ideally decades, then those ups and downs are most likely to average out to a quite strong return. And there are no guarantees, but that is how it's historically been on average. And if you look at what you're paying for buying the stocks and what the profitability is, and you make many scenarios for what profitability could be, then it's not far-fetched at all that you will on average see something like that, even though there are scenarios that could go quite in different scenarios. So when you it's not so sort of the idea that it's like, oh, there could be a correction soon, thus maybe I should hold all my money in cash. You can come to that conclusion every week, and then at the end of the day, you'll just have lost out to inflation on your cash, and probably in the long term have lost out on a great return by not owning stocks. And yeah, so the sort of, there can be special scenarios where you think something is overvalued for a specific reason, but this idea that you should always sort of like hold a lot of your money back or not be invested in the stock market because whatever is the latest scare on the news. And if you just you can either just, if you've invested for a long time, you've become used to the news cycle. You can also just almost, if you find a big stack of old newspapers, you can just see the scare week from week. But I promise you, there's always some reason in the media for why now it's about to crash. That never changes. So it's sort of like idea that now there's this thing and that's why there's about to be a correction. It's always a new reason, like a month ago it was inflation, before that it was a new variant of COVID, and before that there was go a bit back, then it was the yield curve will be inverted. Before that it was, oh, if Trump gets elected, and before that it was like Brexit is going to cause it. And there's always some sort of a mega scare to be scared of. But if you have a portfolio of well-diversified assets that can do well in many different scenarios, then you and you understand that you don't necessarily have to sell everything because it dropped by 20%, and you don't necessarily have to suddenly rush in with all of your money because it went up by 10% or something like that. Then over a period of many decades, you'll probably look back and be very happy you sort of okay, I'll start over on the view. So someone asked your view on cryptocurrencies. So I'm not a fan of blockchain. I think it's a trash technology that does not have any good use cases, but I'm a big believer in private currencies, in Internet of Things, and smart contracts, and non-fungible tokens, and many other things that are often sort of put around blockchain. I think Bitcoin is in pole position to be a private currency for the world, and I have my investment in that. And I think for something to be a great currency, it does not also have to be a great transaction system. So historically, we used to move gold around, then we used to just keep the gold steady and move some pieces of paper around. Then we kept the gold steady and just moved some digits around. And gold stayed gold and continued to be gold, but the way our transaction systems for it changed. In the same way, you could have Bitcoin on the blockchain, but then you have a world of competing transaction systems for how to move ownership over a shared wallet. And then when you have that, you can sort of take all of the financial innovations we've had in the last 200 years, including the parts of regulation that are, where they do it one way or the other, quite sensible, and apply them in this world. And then I think you can have a currency that's, I think if you think even further, what is the ideal currency for the world? I would say that it's a global basket of assets that backs a digital currency that's sort of, and we'll probably get to that eventually, but a good sort of intermediary stage on the journey is something like Bitcoin. Hi, yeah, but when is the best time to increase copy holdings now that we are no longer able to copy open trades when increasing our holdings? So the general rule of thumb is no more than 6% per month, and in general, the more frequent, the better. But of course, the higher frequency can mean more inconvenience. So I've found that a good compromise is to do it every quarter. So if you do it every month, then you have to spend a little bit of time every month. But technically, your money will then, if I do make a trade earlier, you will get that trade earlier, and thus those money become invested earlier. But it can be a bigger hassle. Do it every year, then more money might be idle for longer. But on the other hand, it's less hassle, and you might just have it in the calendar for that. But every quarter with something like 25%, or every month with something like 6% is sort of the limit for what should be sensibly added. What do you think about Chinese stocks for the second half of the year? So I don't care at all about the second half of the year, because that's again based off of the auction mechanism of the market. What will other bid them up to or down to? If people want to bid something up that I own that I don't think have increased proportionally in value, I'm happy to sell it. But that's sort of not what it's not my job to evaluate what others will think things are worth. It's my job to be the best in the world at evaluating what things are actually worth. And I think that there are some amazing Chinese companies that have unfairly taken a drop in price, and it's there's some great opportunities in that space. And then I think the thing sort of with China, there are many different long-term scenarios, and where there can be a lot of sort of counterintuitive risk factors but you can imagine some scenarios where a company loses all its value, but if that value goes directly to another company in my portfolio, then I sort of didn't really lose out. So there can be something that people think is a huge risk, but I know that to me it's not a risk at all. The only thing that could be a risk is if they're made to compete with each other and they both compete their profits down, then I lose out. But so there's sort of a lot of the sort of initial things we think, oh, they do this and you lose this value. It's not always that clear cut. There are many negative scenarios that actually turn out to not be that negative, and that's part of the reason why there are some amazing opportunities in the Chinese markets. But it's also with them. Some good rule of thumbs you always have to apply when you're looking at Chinese companies, and it's certainly big market, many opportunities. Coming from Denmark, a company like Trustpilot went public in April. How do you see a tech company like Trustpilot perform moving forward? They seem to have performed very well in 2020. Thanks. Yeah, it's a great company. I love them. I've used them a lot myself. I don't know. I don't have a valuation on them. They're not part of the. Essentially, I track like 150 companies that are, and then other companies may make it into my list or make it out of it, and potentially I should reevaluate if Trustpilot should be in there. thoughts on S&P being so hot at the moment, how to invest if we overdue a correction. So this idea of overdue correction already responded to, and the S&P, the key thing with I think S&P has changed characteristics. So again, a lot of sort of old rules of thumb and words of wisdom don't apply any longer. People used to think, oh, if you buy an S&P ETF, you'll have a well-diversified portfolio with low fees. But actually, when you calculate the total amount of fees from an S&P ETF, it's actually quite high. And also, when you look at the diversification, many of the ETFs, they don't actually give you the whole thing. They just give you a sort of a mathematically calculated slice of it that's then supposed to reflect the rest. And within that, you have a huge amount that's just the large American tech companies. So there's sort of it can still be a great investment. I have a position in it, and but it's not the kind of investment that most people think it is. It's changed the nature quite a bit. What is your view on real estate investment trusts? Historically, they've provided better returns than the broader stock market. Do you think, based on the macro environment, rising interest rates, it might be worth getting some exposure to real estate investment trusts? Yeah, I think they can be great investments, especially the key factor there is always, if you compare buying a property yourself to rent out or investing in a real estate investment trust, then you can compare the quality of the properties. How do you see this property market? And then you have to also look a lot at the what kind of interest rate could you get on a mortgage? What kind of interest rate are they paying as a company? And then there can be some administrative cost and whatnot that causes it to be a slightly worse proposition. But yeah, it's certainly something that I would love to add some to the portfolio. But I constantly evaluate different ones, and I constantly come to the conclusion, I have something that is slightly better. We know you are top 3 or 5 on eToro. That's why we invest our money on you. But if you are at Fundblock, how do we get the benefit from copying you? What are you doing regarding this, and what eToro is doing regarding it? So you continue to get the exact same benefits. So someone who copied me with an amount of money, that amount of money is still copying me. So when I sell something, you sell something. When I then reinvest that in something else, you automatically buy the same thing. You don't need to add new funds in order for that initial investment to be fine. That initial investment can continue to perform very well. And yeah, if I continue to perform very well, which I do my very best to do, then you will incidentally do the same. Some investors say commodities are a good long-term investment because of the probability of rising interest rates and inflation. What do you think of commodities specifically in that context? I think that certainly commodities, they're not locked in price. Thus, if there is some inflation, it's a thing you can quite quickly, see them adjust proportionally to that price change, and thus they are quite fine protections against inflation. In the sort of in the other scenario, if you have a rising interest rates, then depending on sort of what it's counteracting, it could also be quite fine as well. And they can serve as a sort of a piece of protection for your portfolio towards certain scenarios, but the average return you get from them over a long period of time is not that great. And then the question is, how much protection do you really feel you want to add into your portfolio? Would you rather, if you imagine yourself 30 years from now, and you have, would you rather have twice as much money then, but have had a bumpier ride, or would you rather have had a steadier ride but have half the amount of money? And then the reality is that, to the extent you can allow for a quite bumpy ride, you're going to want to avoid all of these sort of, protect me against this, insure me against that, pay a premium to avoid this risk, don't give me that risk. But if you take all of these medium-sized risks and just say, I accept them, there's going to be a bumpy ride, there'll be good years and there will be bad years, but I know that in the end, my average return is a lot higher thanks to me not having put too much into commodities, then my view is that that is something you want to have a very, very little of. The one that I've chosen to have a little bit of now is in silver. I mean, you can compare that with different other commodities. I think that's the best one, but there could be a different time periods where I would want to have more commodities, and there could be times where I would want to have something different. I used to have gold and oil, which I don't now. Talk of market heading for correction, so I've answered that. Chinese stocks have been dropping for the past months. What signs for investing are you looking for? Well, you could say they are signs. So I have my valuations of all of the different companies that I track. So I mean, certainly if you and everything has a range of importance. So there are some numbers and some societal changes, some things that can happen that I've evaluated is very important. So if there's changes in these factors, it's more likely to lead me to make a change in some things, and there are other things that I evaluate as less important. That's sort of my my unique framework. But it's not. There's never going to be like there's one sign, and that one sign makes me do this one thing. It'll always be a weighing where I say there's many different things that are important, and this is very important and not so important, and so forth, with a number on it, and then based on all of the different things, I come to a evaluation of something and compare that with other things. And then at any given point of time, the things that I've invested in that are the least attractive, they are at risk of being replaced by the assets that are the most attractive that I have not yet invested in. Do you currently have everything invested, or do you keep a percent in cash? I keep a very tiny percent in cash, but I generally have almost everything invested. It's not common that I have significant amounts of cash for a very long period of time. The way, if you see me with a lot of cash at any point, the most common reason is that I've invested, that I've sold something during one market opening, and I need to invest it when a different market is open. Because, for instance, the London Stock Exchange is not open at the same time as the Tokyo Stock Exchange. So if I've sold something in one market that I want to invest in the next one, then it will likely remain as cash until the relevant market opens. Hi, I copied this question someone else made. Low trade frequency aligns with adding more funds. Given the copy, open trade is not an option. Want to avoid having. I've already answered that. Which company stocks do you find interesting for possible investments next year? So that would be the companies that are in my portfolio. These are the stocks that I've deemed right now to be the most attractive companies, put together in a sensible way that is at my risk appetite. So risk appetite is sort of, you have a, I have found a level that I think is most people, and many of my family members and friends copy me as well. So I've sort of selected a risk level that I think is appropriate, where sometimes it can be a little bit higher if I think, okay, here is something, if I do this to the portfolio, it will increase the risk a bit. But I think this has such a significantly higher chance of earning a good return that I think we should take this extra risk. Another time there's like, right, this is going to only on average give me such a small return across scenarios that I don't think we should take this extra risk to do that. So that's something that I always adjust. If you want to find out which stocks I think are the most interesting, then all you have to do is go on eToro and look what's in the portfolio, because that is always that's the conclusion of all my analysis at any given moment. That is the portfolio. Given the recent motions and emotions around blockchain projects, DeFi, and the related regulation, any intention to get into this? So again, there are assets that I track that I think, at a given certain technological developments or developments in terms of adoption or regulation, otherwise, that whereas if certain things happen, then it could be that I need to invest in something else, or there could be certain price levels where I think everything else equal at this price level, I wanna own more. I think with decentralized finance in general, people have to be wary that decentral is not always the greatest solution. Quite often you actually want a central solution. If you have, for instance, we have a lot of buyers and sellers, and these buyers and sellers want to meet, then they can have an Amazon, and then the buyers and sellers can meet on Amazon. And if you need to make some changes to the platform, Amazon can do that. And if they wanted to control it more, you could just have buyers and sellers each own a stake in a company, and then have a company vote on it. You don't really need blockchain to run it in a decentral way, and you don't necessarily even want it run in a decentral way. So I think that can often be like, they have like, oh, we got a decentral blockchain-based solution for something, and you're like, those are some nice buzzwords, but we really have just a bad solution for it. How would you split up $100,000 between eToro, real estate, and crypto? So I would not really put much into crypto, and in general, for wealthy people, it makes good sense to have about 50% in real estate and 50% in stocks. You'll see many that have a large proportion in equity based off of them being the CEO of a company they founded, and and have a family business or whatever. But it can be very good to have a large amount of real estate and stocks, and for instance having 50-50. So many people that have that live a normal life will find themselves at a young age that the best investment they can make is in an education and in trying to get a promotion at work and so forth, then they might find that, okay, buying a property now is great, but there could be periods in between where they have some excess cash that's well placed in some stocks. And then, after a few years, you've started paying the mortgage on the property, you suddenly find yourself with some excess cash again. And then at that point, it for most people in most scenarios becomes very good to start putting that into some stocks. Does it make sense to add funds now, taking into account it may take 9 months for them to be fully invested? What would you recommend? Yes, that makes perfectly fine sense. But again, don't put in more than like 6% every month. Don't put in more than 25% in any quarter, and don't try to double it in more than 1 year, because then for most people that would leave a too large amount idle for too long, essentially, compared with the returns that I sort of expect. What's your personal next level target, as you can't get more AUM at to growth here? I certainly can get more AUM, and I certainly intend to. Now, I cannot get any new copyists, but I can grow the AUM by growing the value of my portfolio. So by continuing to work as hard as I can, hiring more people, and accelerating away from the competition, I can continue to have good returns and thus increase the assets under management. So nothing changes at all from that perspective. It's I will continue to focus on being the best in the world at valuing companies and making the best investments from that. And with that, I will also grow my AUM if I succeed in what I attempt. Given the volatility of crypto, some people have suggested to invest in exchanges like Coinbase. What are your thoughts? I think there are some amazing companies in those spaces. Unfortunately, many of them also cost quite a lot. And oftentimes people have this idea that if a company is great, it's also a great investment, but that's not also always the case. You can have a company that's really amazing and it's really likely they're going to have a really grand future. But if you're already paying a very high price for that company, then that great future is already included in the price. And then when that amazing future comes to pass, you'll see, wow, you didn't actually make that much money on your investment. Vice versa, you can have a company that, because it's so cheap, even if it goes bankrupt after 10 years, the money you'll have made over those 10 years might have more than paid off what you paid initially, and so that actually turned out to be a fine investment. So it's always a question of comparing. What are you? What's the asset worth, and what are you paying? And so I have evaluated, for instance, Coinbase, and found that to be an amazing company, but at what I would consider a too high price. How much is still possible to invest with you? So if you're already a copier, then you can continue to invest, and I think the maximum you can invest on eToro is $2 million. So yeah, that's the limit. If you're not already copying, then it's not possible to start now. Thanks. So you said you tend to invest in industries you have experience. In the spirit of risk spreading, how do you compensate for not having a wider spread of investments? Also, lovely living room. Well, thank you for the compliment. So as a management consultant, I was sent to work in many different industries, and that has given me, and I've also lived in many different countries. So that's given me the ability that within the things that I know, I can invest in different industries. But for instance, me and most other people in the investment world, when cannabis became a big industry, did not have experience in this industry. Nobody did. When you try to on long industries that have existed for a long time, you can buy all of these great detailed reports. You can talk to all these experts that have many years of experience. But when the cannabis industry arose, it was sort of the Wild West. Nobody knew anything. I had to call people that I knew in Canada that worked for some of these companies, and really scramble to get the most information here to make the best investments as fast as possible, and faster than most other big investors. And yeah, then it's so for any sort of I have sort of a rank list of things that I need to know, and what do I need to know more about this? How important is it that I know more about this? How much time is it going to take me to know more about this? And then I sort of always rank. So I follow a research plan very carefully. If there is something that I feel like I'm not so certain about, I sometimes hire like a PhD students to teach me the knowledge they have in their field, because then I can sort of ask a lot of questions, they can answer them, and then I can sort of accelerate my knowledge in something quite fast. But the different countries that I've lived in, and the different industries that I've worked in, allowed me to have a sufficient amount of spread to keep the risk quite low. And the thing with risk management is, if you only have one investment, it can be very, very risky. If you go from 1 to 10 in different industries and countries, then you massively reduce the risk. And if you go from 10 to 100, you also reduce the risk a bit, but it's very sort of diminishing risk reduction to more assets. So you don't actually necessarily need to have 56 assets I do, and you definitely don't need to have 500 or 1,000 assets to keep a reasonable risk profile. All right, and with that, thanks everybody. And yeah, if you have any more questions, please just comment on eToro or add me on LinkedIn or watch some of the YouTube videos.
Thank you so much, Jeppe, for a great presentation as usual. And thank you everyone for joining. Have a great evening, afternoon, wherever you are. Bye-bye.